Hey guys, so here we are. We're here with Rob again. You guys know Rob. He is our trusted advisor. Rob, how's it going over there?
Doing good. We're making loans, and people are still buying houses. So
Yeah,
it's here we are, like kind of week. I don't know, what is this, week 3, week 4,
I know. I
and
was saying the same.
working from home.
I know. I was saying the same thing to a friend of mine earlier. I said, "Gosh, how long have we been doing this?" I think we're on, 3 or 4 weeks now. But yeah, I was a little bit surprised myself of you know, like we talked about the last time, how well we're all adapting to this, and people are we're doing fine. We're doing fine, and we're getting business done. I am hearing that some people are getting furloughed, and but it's just a furlough. They'll be back at work, and so, but we are. From what I'm seeing in the news, I'm hopeful. It looks like we're flattening the curve, so we're staying home. That's a good thing. Continue to stay
Right.
home. I've been doing I think I mentioned this too last time we chatted, just a week and a half ago or so, and I'm doing more listing appointments by Zoom, and everything we can to keep people safe and not spread this damn disease. So, but here, let's get caught up and let us know. Tell us where we are with where are we with mortgages, and where are we with interest rates? What are you seeing?
Yeah, no real change in interest rates. They're still kind of upper twos for the FHA and the VA stuff, and the conventional loans are in the mid threes.
Let's
Um,
stop. I want to stop you for a second there. The upper twos and the lower
yeah,
threes.
the upper
Okay.
twos. Yeah,
Yeah, because
I know,
last
right?
year, this same time last year, we were doing loans in the fours. That was
Absolutely.
pretty standard in the fours.
Yeah,
And I
yeah.
even had somebody who was in the sixes. And so, yeah, so the upper twos and the lower threes is pretty remarkable.
It's pretty good. Yeah, I'll tell you that there has been a kind of a shift recently and this has been since we last talked, in the fact that the what are called high balance loans, which are available in the Washington D.C. area and other high cost areas throughout the country, where typically you have a conforming loan where the loan limit is $510,400, which is available any place in the whole country, and then in places that are not as costly as this, anything over that is what's called a non-conforming or a jumbo loan. Okay, but in these high cost areas, we have available to us Freddie Mac and Fannie Mae securitizable loans that run from in the Washington D.C. area 510, 400 to 765, 600. And what ends up happening with those loans is that they're securitized in a slightly different fashion, I'll say. And so as a result, the pricing differential on the loans between a normal $510,000 loan and a $600,000 loan, the gap has now widened, and rates on those loans that are over 510,400 are not as good. It's more exaggerated in the conventional loan market than it is the government, either FHA or VA market. But with both, there's a larger gap between the under 510 loans and the over 510 loans than what there has been, historically, at least over the course of the last couple of years. And so, just kind of an interesting observation. And it's not like the loans are any more difficult to get. It's just a matter of the pricing is not what we've grown accustomed to, where it's almost the same for each loan product.
Right.
Okay. Um, Something else that I've seen that's been a shift recently, and that I think merits talking about, and I think I talked about this in the last session, but I don't remember whether I did, is that this whole question about how we've got to verify employment, okay, and that there is an employment verification that's done early in the process. That's been something that the industry has done for 30 years, for as long as I've been doing this. It used to be that that was where it stopped. Well, in the last number of years, it's now changed to where the employment verification gets done a second time, and it gets done close to settlement, typically within 5 days of closing. Okay. What's been happening over the last several weeks has been because the employment numbers have changed so significantly, and so many people have been laid off and such, is that now we're putting policies in place where it has to be done 2 or 3 days prior to the closing. Okay. one of the challenges that we've run into, and that I know other mortgage companies have run into, is the fact that the groups that handle the employment verification are working from home. And so, and the normal mechanisms in place, some of them aren't, you can't get the responses back that you need. So just be aware of the fact that there is, and I personally haven't had any closings that have been our inability to get a done, but I know of other people who have it delayed because you couldn't get that final employment verification done that was needed to be done right prior to settlement. I heard yesterday that somebody was requiring that an employment verification be done again the day of closing. So a different lender, not our company, but who knows where. Everybody's got their different policies in place, and the policies from one lender to another right now are much broader than they normally are.
Yep.
So everybody kind of adapts to this now. What I did have happen, and I think this is something that might be valuable for people to hear, is that I had somebody who was supposed to close last Thursday or a week ago today, and on Thursday morning, I got a call from the buyer, and the buyer said, "Hey, I just found out last night that my hours have been temporarily reduced by 25%. So I'm only getting paid 75% of what the normal income is that I have." And I'm like, whoa, okay, thanks for telling me, but we have to stop closing. You are not going to be able to close with that being the case. We had done an employment verification actually earlier that day, actually on Wednesday of last week, and the employer didn't tell us that they had reduced hours. So the buyer told me that. I then have a responsibility legally to say, okay, I know this now. We have to stop this closing and sort this out. Now, as it turns out, the buyer at 75% of his income doesn't qualify for the loan. And so what we ended up doing was, fortunately, this buyer had some extra cash reserves, and I was able to get him to pay off some other credit card debt, which now enabled him to qualify based on the 75% of his income, and he's going to settlement later this afternoon. So it worked out okay. But if he didn't have those extra assets, he would have been stuck. He would not have been able to close this transaction.
Right.
And he only had his hours cut by his pay cut by 25%. People would have been totally laid off. So, one thing that I will tell you is that the lenders are probably going to find out what's going on with your employment. The sooner you're aware of there being a potential problem, talk to your lender about it and say, hey, look, I may have a potential problem. I may be getting a furlough. I might be getting reduced hours. I might be having something happen. As soon as you're aware of it being a potential problem, talk to the lender about it and see if we can do something about it. We had another situation a couple weeks ago where the buyer did tell me that. It was actually a realtor that I'm doing a loan for that's closing next week, actually. And she had a reduction, her spouse had a reduction in income. It didn't make any difference. They just qualified fine with the income that we already had verified, combined, and then taking into account the lower income for the spouse. So, it may work out fine. It may also not. But the earlier in the process we're aware of it, the earlier we can deal with it and have it not be a problem that may cause a delay in the closing as the verifications are obtained where it changes something.
Yeah. But it occurs to me too, as you're telling that story, it occurs to me that it is in our long-term benefit that if that is the case, that if that's something that's going to happen to you, that you're going to get furloughed, that it is better to talk about it up front, as opposed to not say anything and then get in kind of the situations that people were in that during the housing crisis of 2008, because loans were being made to people that weren't really qualified. And you can only go by the information that you're told. And, it occurred to me as you were telling the story about the person who, you had verified it earlier that day and they were fine. And then they found out. Thank God they found out.
Yeah. Yeah. Okay. I found over the years that sometimes buyers don't think that we're on their side. It's like, oh, this is the bank. They don't want to make the loan. Whatever. I don't know why anybody would think that, but we're your ally. We're not your enemy. And the more information that we have, that be able to to navigate the waters that we're in. And what probably irritates me more than anything else in this business is that when somebody doesn't tell me the truth, and then we find out about it later on, And then we have to figure out like a solution to still make the loan work if that non-truthful statement that they provided me to begin with was something that was really critical, and so just, level with us, tell us what it is. There's oftentimes many solutions to get to the finish line when you have a problem. But if I don't know what the playing field looks like because I haven't been given accurate information, at that point, I may react a certain way, and it may end up turning out to be the wrong way because I was reacting to what I thought was correct, and it turns out what I was told was not truthful. So just always be truthful to your lender is what it comes down to.
Yeah.
I don't know how else to say it. Just
Right.
always tell them what's going on.
Well,
We're your friend.
Right.
We're your friend.
And it occurs to me too that, what we're experiencing right now is temporary. I have a friend in Atlanta, she got furloughed, and it's temporary, so while she maybe couldn't get the loan right now, she can get it later on when she goes back to work and she's back in solidly, and we've passed this crisis.
Yeah.
So it's just a temporary situation.
No, I totally agreed on that. Yeah. That was funny. No, so that was, I mean, that's true. I mean, there's a lot of people who are in that same position where, they have been furloughed, they've had a reduction in hours, but it is going to be temporary, and who knows exactly how temporary it is at this point. It's a moving target, I think, but I think we do all realize that it's temporary for sure.
Yeah. Rob, what about credit scores? Has there been any adjustment in credit scores? And have the guidelines there changed at all?
Good question. Yes. To give you a short answer, the answer is yes. We have changed guidelines. Every lender that I know of has changed guidelines in terms of minimum credit scores for various loan programs over the course of the last, call it, month. Different people did it 3 weeks ago, 4 weeks ago. Other people may have done it a week ago. But yeah, one of the things that I have seen is that we as a company have said that we will not do a loan with a credit score less than 620 at this point, whereas with FHA and VA, used to have some options where we could go as low as 580. Okay, and that really stems from the secondary market not wanting to buy lesser quality loans. There's no place, nobody will buy that loan at a 580 score.
Bernie wants to be a part of our video. So this
we like Bernie. Yes. Bernie has been a part of our video before.
He has. And so as this is real life. This is working from home. Everybody's familiar with it. So sorry for the little interruption, but keep on.
I think it's good. Bernie can learn something about mortgages here. It's good.
Yeah, he's going to grow up. He said he wanted to grow up and be a lender. He told me that.
That's cool. We need more manpower. Send him on over. I love him. So the credit score minimums have changed. The other thing that's come into place is that a lot of lenders have put other stipulations in place, such as we took over a loan on Tuesday from another lender where on Monday night, they basically told the buyer, hey, there's a requirement that you have 6 months of liquid payments in the bank for whatever your mortgage payment is. His mortgage payment is going to be about $4,000 a month. So he had to have almost $25,000 in additional liquid assets that he did not have. It was a VA loan. It's a pretty standard normal loan, but they put this stipulation in place saying they're going to require that everybody have 6 months of reserves or they're not going to close the loan. Okay, so there's different things that are happening, and this is an evolving on a daily basis type thing. But there are, without a question, different requirements now, and the credit scores that used to be accepted for certain loans are no longer going to be accepted across the board. Yes.
So I know a lot of people, they go on to places like Credit Karma and they check their credit on Credit Karma. How accurate are things like Credit Karma for somebody who's, let's say, like I've got a buyer, I met with them just the other day, and they're just now beginning their process, and so they're checking on Credit Karma. How accurate is that?
We love hearing Credit Karma, and I say that very facetiously. I can't stand the statement, oh, my Credit Karma score is 700 or whatever it might be. You can't fault the consumer for this, but because there's so much information out there about monitor your credit. You got to have great credit. Here's a way that will let you do it, and so the bottom line is that there are 3 credit repositories: Equifax, Experian, and TransUnion. They each have a number of different, I don't know how many, but a number of different scoring models. We as mortgage lenders use what's called a 3 repository merged report. So it's going to end up being a certain model from Experian, a certain model from Equifax, and another certain model from TransUnion. The Credit Karma or the Credit Angel or the Credit whatever it is, they don't use the same models. So almost invariably, somebody will tell me they've got a 700 credit score, whatever it is. The credit score that we're going to pull is most of the time going to be a little bit less. Okay. And then the other part of it is that we pull a 3 repository report, which is required by the industry. If you only have one report and that score is 720, and then you have 2 other reports that the scores are both 680, then for our purposes, we're going to take the middle of the 3 scores. So that person would have a 680 credit score, even though the credit score that they're looking at is a 720. So the bottom line is that if I hear from somebody, hey, you've got a 780 credit score, I know that their credit's going to be pretty good. I don't know exactly how good it's going to be, but it's going to be pretty good. I hear from people, I've got a credit score of 1,000. Well, the model that we use only goes to 850, so you don't have 1,000. So well, suffice it to say that it's one of my pet peeves, and we'll just leave it at that. But
well, I think it's
there's more credit there's more credit than meets the eye. And Credit Karma, it doesn't really matter what Credit Karma tells you. You got to talk to a lender and get a 3 repository real report, and at that point, that'll dictate what types of loans you're going to get, what kind of rates you're going to get.
Yeah, but I mean, I hear it all the time. People say to me, I'm out, we're shopping. By the time we go out and we shop, they've already gotten the pre-approval. But let's say it's that initial conversation I have with someone and they've not yet had a conversation with you or whoever their lender is, and I'll say, are you pre-approved? Have you been pre-approved? And they'll say, no, but I know I'm really good because my Credit Karma score is really high. Okay.
Yeah.
And so I have the same thing where I say to them, go talk to the lender and let's find out what the real score is. And because at the end of the day, if Credit Karma says that you're 780, but you're really at 580, there's a flaw in that, and you're not going to get the loan. And so that's the important thing for people to understand is that you guys are going by your score, not the Credit Karma score.
Yeah, that's right. Yeah, I mean, without a doubt. Something we hear a lot from people is, oh, I just had somebody pull my credit report. Now you want to pull it again. I've always heard that too many inquiries are going to be a bad thing for me.
Yes.
And, the credit scoring models have now kind of adapted to this. And what you're going to find is that now they'll let you shop around amongst as many different mortgage lenders as you want over a 30 or a 45-day time span. And as long as you have mortgage inquiries during that time span, it doesn't matter if you have 1 mortgage inquiry or if you have 15, they're going to only count it as 1 mortgage inquiry because they realize that you're only going to end up getting 1 mortgage, and they want to give you the opportunity to talk to multiple lenders about the offers that they might be able to make to you.
So people do get concerned, and I have people tell me this. They say, oh, well, if I go to 3 different lenders, then it's going to reduce my score. How much do those inquiries, do they actually affect the score?
If they all took place in that short period of time that I just mentioned, they won't impact the score at all. It won't matter if you have 3 or if you only have 1.
Okay. But if I'm getting a mortgage, a brand new car, and I'm going to finance all the furniture that I'm going to put in my house, I got a whole different
different ball game there for sure. Yeah, it would be multiple inquiries. Now, I'll also tell you that multiple inquiries and the impact of inquiries is pretty minimal on somebody's credit score. And so, there's plenty of people out there who may have multiple inquiries and their credit scores are still 780. And so it's not going to all of a sudden take somebody who had an 800 credit score and turn them into somebody who's got a 650 credit score. It might take somebody who had an 800 and reduce it to 780, but at that point, it doesn't really matter. I mean, at 780, you're going to get the same terms of the loans as you would get at 800. Generally speaking, 740 to 760 is the range where once the scores become less than that, depending on the loan type and depending on what piece of it you're talking about, there start to be some additional costs the consumer may incur by having a less than either 740 or 760 score.
Okay, great. So, but again, going back to the original part of this conversation, the score that you guys are looking for right now, 620 minimum.
620 at a minimum, correct, to be able to get normal, any sort of financing. There's another part of our market that used to be called subprime that is now called non-QM, QM standing for qualified mortgage. And it's been a part of the business that over the last several years has grown quite a lot. And what it allows is for people who may not be able to document their income the normal way. So somebody who's self-employed, where you typically are going to document their income with tax returns, they've had a ton of write-offs, so therefore they don't qualify for a normal conventional loan. You can use bank statements. They'll basically use the income as compared to the actual tax return to document this person's income, okay? And like those loans are called non-QM. The loans that are for somebody who had a 550 credit score before, those are non-QM. That market is all but evaporated, okay? So there's very, very few lenders that will play in that market. I don't know of a lender that is still operating and lending in that market right this minute. There probably is somebody, but none of the big lenders that we would use are even participating and even making loans in that market right now.
Would you expect, once we get past this crisis, would you expect those lenders to come back?
I would say probably so, assuming the real estate market, rebounds and I say rebounds. I don't know how much it's going to actually be impacted by this, but we haven't seen much impact yet. People are saying that we will. I don't know whether we will, whether we won't. And so as long as the real estate market stays healthy and values stay healthy, then at that point there's certainly a place for those loans. Yes.
And I'll say, just from my own experience on the other side, that's just preceding you, I'm still seeing people. I've written in just the last couple of days, I've written 2 offers, and I've gone on multiple listing appointments and have signed listing agreements, and I've had properties that were listed and actively on the market go off market. One of the ones that we're in the middle of a negotiation right now, and we thought, well, you know what, hopefully the market is slowing down a little bit and you'll be able to get in and slide in before anybody else comes in and you won't have any competition. No, guess what? 4 offers on that house. So yeah, we're reconfiguring our offer and making it, just like we would write it in a normal market, very competitive. So
yeah, I
am not seeing any change.
Yeah, I was involved in an offer situation this weekend where there were 6 offers.
Yeah.
On the same property. And it's, everybody said 3 weeks ago, oh, that'll stop. Well, it's funny because it didn't stop the weekend after everybody started staying from home. It didn't stop the weekend after that. It didn't stop the weekend after that. I mean, does it stop this weekend? All right, it's Easter weekend. It's a holiday weekend for a lot of people. Maybe it does. I don't know. But I mean, there's buyers who I've qualified this week who I know are intending on making an offer on a property. I talked to somebody this morning that I qualified yesterday who is making an offer today on a property. So, I mean, people are still out there making offers on properties and getting them accepted, and houses are buying and are being bought and sold for sure.
Exactly. So all it tells me is that in spite of COVID, in spite of the fact that we are being good citizens and we're all staying at home, we're still doing our stuff. And virtual tours, I can tell you that my virtual tours, my hits on my website and the hits that I'm seeing on my virtual tours, those are increased. My ads on Facebook, people are watching more of the virtual tours. They're seeing the virtual tours, but they're still asking to go see properties.
Yeah.
Things are still moving, not fully business as usual, but some business as usual. People are still.
Yeah, I mean, I think it's business as usual, maybe with the new situation, right? I mean, it's like everybody's being more protective and they're being more polite and they're being, more they're wearing booties and masks and using hand sanitizer and wearing gloves and all those kinds of things, but people are still going to buy and sell houses. I mean, I don't know if ultimately this changes. I was talking with a friend of mine yesterday about what do we, I'm a big sports fan. All right. Well, what happens? Will there ever be another baseball game where there's 35,000 people in a stadium that are that close to each other? I mean, does that change the dynamic? What happens to the, and so there's going to be things that are going to change. There'll be things that we'll live with for the rest of our lives and that our kids will live with for the rest of their lives that are going to come from this, I think. And, we all just need to adapt. I mean, is it basically the new norm where you go into a house 10 years from now and it's expected that you wear a mask and gloves? Maybe it is, who knows? But people are still going to buy houses, they're still going to sell houses, and they're still doing it right now. So
yes,
exactly. That's the reality of it.
Yeah, maybe we'll get bigger seats on the airplanes and more legs.
that'd be okay, right? We'd all like that. We'd all like that. Yeah, for sure.
All right,
for
well,
sure.
Rob, I think that's it for today. Thanks, guys, for watching us. And as always, Bernie has a few things to share with us over here.
Bernie's going crazy back there. Hey, thank you guys, and thank you, Michelle. And we'll be back to you soon with some additional updates.
Yeah, awesome. And as always,
okay.
Lean into the folks that you trust. You can trust me and Rob. You know how to reach us. It's in the bottom right here. So we'll see you on the next visit. Rob, stay safe.